Hello everyone. In this video I'm going to be walking through your assignment number 2 and also working through the workbook that you'll need to complete to finish this assignment. So just to go over the instructions here, for this assignment you'll need to complete the workbook and then answer the following questions and then upload your the workbook and the answers to your questions to D2L by Wednesday, April 1st by 5 p.m. So the questions you'll need to answer are whether or not, well, number one, the policy document states that the fund should not have more than 10% of the fund in one stock. Are there currently any investments that are above or nearing that 10% threshold? If so, which ones? What percentage of the portfolio is invested in firms that are in sectors that are cyclical? What percentage of the portfolio is invested in firms that are in sectors that are not or counter-cyclical? And you'll need to listen to the lecture on macroeconomy and industry analysis to be able to answer some of these questions. The third question, complete the SIF, size and style regression. SIF stands for Student Investment Fund. We actually worked through one of these regressions in class already. I worked through another one in the video, just a little refresher on that. And then it asks some questions about the regression. I have you calculate the Sharpe ratio, Jensens Alpha, and the trainer ratio to give a perspective on the risk-return relationship of the student investment fund versus the S&P 500. And then you'll also calculate the standard deviation. I ask you to complete the worksheet return measures to see if the student investment fund outperforms the S&P 500. And then I want you, number 6 is probably the most important question and certainly the longest question in this assignment. I really want you to consider what the student investment fund should look like going forward. Are there areas where we need to reduce our exposure to certain sectors or refocus on size or style? And really consider what that should look like, because one part of this is going to be maybe reducing our exposure in certain areas, and that will also free up cash to invest in new areas. So that's really really important for that. We assume, or I assume, through the assignment and for right now that the S&P 500 is our benchmark. It's kind of alluded to in the document setting up the student investment fund. I do put a note up here. I don't have the history of the investment fund. I don't know when certain stocks were bought and sold. And so I don't know the history of how the fund got to be where it is now with the types of investments that it has. So what we're using for the calculations here are the current holdings, and then I go back 5 years for the prices for the individual stocks to calculate the value of the portfolio over time and the returns for the portfolio over time. So keep that in mind, that it doesn't, the results you're going to get don't actually represent the history of the portfolio, but rather the history of the current components of the portfolio. All right. The second document that you'll need for your assignment is this one that has some equations on it. It's got the Sharpe ratio, the trainer ratio, and Jensens Alpha. We're going to use these in the examples today as well. And then here's the workbook. If you downloaded the workbook from earlier, it's been out there for a few days now. I ended up having to reconfigure part of the workbook to make it easier to teach online with. And so I've done that. And what I'd like you to do is, to the extent that you're able, follow along and do this with me with the existing workbook. If you don't have access to the Excel plugin for Capital IQ, please let me know and I can send you a workbook that has all the prices in it, and you won't need to use that. But if you do have that and it is available to you, I encourage you to use it. It's going to possibly make the next few assignments a little bit easier for everyone if you're able to do that. So this is the first worksheet. It's called Portfolio. This is what was sent to me prior to the beginning of the class, and then I've set it up so it updates using Capital IQ. So I've got the date up here of 3/10/20. It is actually today 3/20/20. If I put in today's date, it doesn't really work because it's, well, it does work. Let's see. If I put in today's date, it's going to update to the most current numbers for the stocks in our portfolio. If you remember, our portfolio began at $255,000 at the beginning of the semester. We haven't changed anything in it, the same holdings. However, the value, because of the drop in the stock market, which has been pretty significant, then the value of our portfolio has fallen from $255,000 to $194,000, which is pretty dramatic. You'll notice here where it says price change and price change percentage and day change and day change percentage, it's not showing anything. That's because the end of the day has not occurred yet. If I change this to the prior day, you can see because we have end of the day prices for March 19th, it does show us the price changes for the day, which you can see for some fairly dramatic ones here, and the market value change for the day as well. So that's that first worksheet. If I go out here, I've added a few things to what I received. I added the CIQ target value. I don't know how relevant that is now because things have changed so quickly, so fast. But these were the target prices according to the analysts that Capital IQ uses for the individual stocks. Again, you can see they're all in the reds, meaning that they're all, the current prices are all lower than the target prices from the analyst. And that's in part due to the drop in the stock market in the past few weeks. We've got one here that is the current price is less than 50% of the target price, and that's a very small company called PJT Partners. Over here I put out the individual sectors. You'll need this for answering one of the questions, and I'm going to get into that on the next page. But this indicates which sector each firm is in, and then the primary industry over here for each of the individual firms. So if we go to the sectors, if you look back in your notes for macroeconomy and industry analysis, it goes through the individual sectors and which ones are cyclical and which ones are counter-cyclical. And here we've got each of our investments currently, including cash, which doesn't actually fall into a sector, and which sector each of these firms falls into. You can see we've got a few in communication services, a few in 4 in consumer discretionary, 3 in consumer staples, 1 in financials, 3 in healthcare, 3 in industrials, 4 in information technology, and then 1 in utilities. And this is the current percent of the portfolio based on the date that I put out there of 3/19. This is the percent of the portfolio that each of these makes up. This portion right here just breaks down our ownership by sector, or percentage, the percentage of our portfolio that is made up in each sector. You can see here information technology makes almost 30% up of the portfolio. Healthcare makes up 19.45%. So these are pretty large percentages of our portfolio, and it's something you may want to consider. We have 0 in energy, 0.09 in financials, 0 in materials, and so on. On this page, so now I'm on the prices worksheet. I'm going to show you how to use Capital IQ to insert the prices for each of the holdings of the portfolio. So, and again, if it's not working for you, let me know. Sometimes there's errors that I can help clear up. Sometimes it just won't work, maybe because of the type of computer that you have. And so I'll help you out with that to make sure that you have all the information that you need. If If you go into, so what I did here was I opened up the S&P Capital IQ tab, which will show up after you install the Excel plugin for this. I go to Formula Builder, and then it says, I'm going to open this up a little bit more so you can see it better. So it'll say identifier or cell. So in this case, we want to click cell, and we're going to use the ticker, the stock ticker for our identifier. If you just have like one identifier or one stock you're looking at, you can click identifier and put in the ticker symbol. There's some other ways that S&P Capital IQ can identify individual firms, but that's the one we're going to use. And I've checked out all these tickers to make sure that all of this works. So I'm going to put in here that I want the prices. So I'm going to go to market data, equity market data. So it's got some things on here. I don't want the last sales price because we're going to actually do this as of certain dates. We're going to get the price for each of these dates along in column A. So on here, I want to choose the dividend adjusted daily close price or day close price. What this does is it adjusts the price for stock splits, cash dividends, rights offerings, and spinoffs. And so I want that to be as of the date in this cell. So I'm going to point it to 3/120. And then down below here, you can see that our function that we've created says CIQ for capital IQ, B2. So that's our identifier. The variable we want to look up, the IQ close price adjusted. And then the date is on A3. And so I want to click add formula and then press apply. And you can see here it showed up right there. The adjusted daily close price for Adobe Inc. on March 1st, 2020 was $345.12. So now I can hit cancel here, and I need to do a few things and then I can just use it for the rest of this spreadsheet. So I want the identifier to stay in the same row but not the same column. I want to lock the row in place, so I'm going to put a $sign in front of the 2. So it's going to always point to this second row no matter where I'm at in the spreadsheet. And then I want the date here to stay in column A. So when I pull this to the right, for each of these, it's going to look back on the first column for the date. So now I'm just going to take this, drag it over, and I'll need to correct one of the columns here. I'm going to drag it down. All the way to 5 years in the past, March 1st, 2015. You can see here for one of our stocks, this stock didn't start trading until September of 2015. That's that PJT Partners. It's a small amount of the portfolio, a very small amount of the portfolio, so I'm not going to worry about that too much. The portfolio value says invalid identifier because our identifier just is the term port value. That's not actually an equity, so we're just going to get rid of that, and I'm going to show you how to calculate it. So we've got all the prices for each month, the closing prices for the first day of each month for the past 5 years. To calculate the portfolio value, I'm going to use matrix multiplication to multiply the price on this date by the number of shares currently that we hold. So I'm going to put in equals mmult, open parentheses. I'm going to highlight the row here and then press comma. Then I'm going to go back to portfolio and sorry, I'm over to the right too much. I'm going to scroll over to the left where it says quantity. I'm going to highlight that row, that column, close parentheses, and then before I press enter, I'm going to hold down Control and then Shift and then enter. And so that we get the portfolio value. So I multiplied two arrays together to get the single value for the portfolio on that date. Then I'm going to make one change because I want to lock in those values for the number of shares. And now I'm just going to pull this down. To the bottom there. So there's a few things that aren't precise here. Like I mentioned, we didn't own this stock 5 years ago because this stock, PJT Partners, didn't exist 5 years ago. It makes up a very small amount of the portfolio, so it's not anything that's very significant there. We own 6 shares of this stock, so it's a total of a little under it's $166 of the value of the portfolio today. The quantities of the stocks have changed over time, because if you go over here to reinvest dividend, as dividend comes in on these stocks that have yeses by them, so all but 2 of the stocks, those dividends are reinvested back into the stock. So these values have been changing a little bit over time based on the amount of dividends that the firm pays. All right, so now I've got our portfolio value, and this is the prices for all of the stocks. I've also got out here the value for the portfolio. And then over here we have the values for each of the size and style indexes. So the first one is the large growth index. So Russell 1000 is a large index of large stocks, and this is the large growth, so size and style. The second one is large for the size and value for the style. The third one is the Russell iShares Russell 2000 growth. So Russell 2000 is small stocks, and so this is small growth. And the last one is, oops, that's not what I want to do there. The last one is the Russell 2000 value, so that's small value for size and style. You might notice here that this is, I show the name from Capital IQ. I found this is useful because if the ticker symbol is confusing, or maybe there's an international firm that has the same ticker symbol on an international exchange that is the same as one on a domestic exchange, you can run into some problems here. So that's why whenever I use ticker symbols, I always also have Capital IQ show me the name so I can verify that it's showing me the prices of the company or the index that I think it should be showing me. Alright, so on this prices page, we have this all filled out now. The last column here is for the S&P 500 index. This is an ETF, a spider ETF that tracks that the S&P 500. You'll notice it's smaller than the current S&P 500 by a lot, because this is 1/10 of the value of the S&P 500, and that's the price of that ETF. However, it generates the same returns, or very, very close to the same returns as the actual S&P 500. So the next tab is returns. So we're going to calculate the returns by taking the natural log, so equals ln, go back to prices, and so this is for the portfolio. So I'm going to take the most recent value that we have on here from March 1st divided by the value for the previous month. So I have the natural log of the price or the value of our portfolio on March 1st, 2020 divided by the value of the portfolio on February 1st, 2020. Then I can make it look nice here. I'm just going to put home, show me the percentage. Took a big drop in March, or excuse me, in February. It's taken a much larger drop since March 1st. I'm going to pull this all the way across. And so this shows us for the size and style indexes what the return was also during that time. I'm going to pull this all the way down. You'll notice it goes down to April 1st because it doesn't go down to March 1st, 2015 because we need that additional month there to make that calculation. If I did pull it down one more, we would just get error terms here. So I've included this data. This is the 1-year U.S. Treasury and the 10-year U.S. Treasury. These are going to be our risk-free rates. Okay, these are going to be our risk-free rates here. And I pulled these down off of the Federal Reserve website. These are the monthly, so the periodic monthly rates for the 1-year U.S. Treasury and for the 10-year U.S. Treasury. That's why they look really small, is that this is just a periodic rate for 1 month. These are also, all of these returns here are the return for that individual month. The S&P 500, we're going to do the same thing here. Put in equals ln. Going to go back to prices. For the S&P 500, we're going to take the most recent value of that ETF divided by the previous value. Again, I'll make it look a little nicer here. And we can do the same thing here, although it's going to look really small. Don't drag down that middle one because those those middle two risk-free rates, because those values are set in there, are just are pasted in there. They're not a formula. All right. So the last thing we're going to do here is calculate the excess returns. So this is the student investment fund minus the 1-year risk-free rate. So our student investment fund portfolio value minus the return, the periodic return for the risk-free rate there. Pull that down. The student investment firm minus the 10-year risk-free rate. The S&P 500 minus the 1-year risk-free rate. The S&P 500 minus the 10-year risk-free rate. So in the calculations, I'm going to fill in the ones that aren't shaded yellow for your assignment. I want you to complete the ones that are shaded yellow. If you look over here, and you can certainly hide these middle columns now because we're kind of done with what you'll need, at least for right now with those. You might need to unhide those later. But our top row here down at the bottom is the monthly average. So to get that, you can see I just take equals average. And then I highlight this column. So I get my monthly average for the excess return, or the excess return for the student investment fund. So the amount minus the 1-year U.S. Treasury rate. So the average is 0.94% per month. The annualized value, we get that by annualizing it by taking equals 1 plus our monthly number raised to the power of 12 minus 1. So we get 11.91%. Our monthly standard deviation is equal to STDEV.S. We're using .S because we're assuming that this is a sample and not an entire population. And then I annualize that number by multiplying it by the square root of 12. So I'm going to take that number, I'm going to multiply it by the square root of 12, and that's how we annualize a standard deviation, a monthly standard deviation. We multiply it by the square root of 12. So again, what I want you to do is complete the yellow cells here. So the last number we have down here is the Sharpe ratio. Excuse me. I have allergies. I'm not, nothing else going on there. So if you go back out here to the equations, our Sharpe ratio is the return for the investment, individual investment, minus the risk-free rate divided by the standard deviation of the investment. Numerator is the excess return, or the market risk premium. Actually, in this case, not the market risk premium, the risk premium for the individual asset. So we've actually calculated that already. This annualized number is the numerator. For the denominator, we're going to use the standard deviation of that excess return, 12.61%. And so that's going to give us a value of 11.91% divided by 12.61%, or, and this actually shouldn't be a percentage, this is going to be 0.94. And remember, the way that we use the Sharpe ratio is we use it to compare with the Sharpe ratios of other firms. I'm going to do the same calculations here. Take the monthly average, annualize that, find the standard deviation, annualize that, and then finally calculate the Sharpe ratio by taking the annualized return divided by the standard deviation. And that, oops, make sure I get all of these correct. Those are the answers using the 1-year U.S. Treasury for the risk-free rate. What I'm asking you to do is calculate it using the 10-year U.S. Treasury as the risk-free rate. And that's going to really matter when we look at things like Jensens Alpha, where you're calculating the excess return, because we're going to get two different market risk premiums between the 1-year and the 10-year Treasury rates for the risk-free rate. And you'll see this later on. But right now, know that this is our estimate for using the 1-year U.S. Treasury as the risk-free rate. This is our estimate here of the market risk premium, 7.70%, because it is the average annualized difference between the return on the S&P 500, which we're going to say is the market, and the risk-free rate. So on the SIF size and style regression worksheet, I'm going to have you calculate the regression for, or estimate the regression for, the student investment fund returns on the returns for the different size and style indexes. I'm going to first work an example of this, though, using the S&P 500. And so down here, it says don't change the formulas in the blue cells. I actually have to change one of the formulas down here because it points to this this cell here, F7, and what goes in that cell is actually the degrees of freedom, and we need that to calculate the p-value. So I'm going to point it to where it should be in this cell right here. So that's F18, and I'm just going to change these. And pull that across, and now our table will work here. So like I said, I'm going to regress the returns for the S&P 500 on the size and style indexes. So to do that, I'm going to highlight the yellow area and then type in equals lineest, which is the line estimator. Open parentheses, the known Y's are going to be the returns, the monthly returns for the S&P 500. So I'm going back to the returns page. In column I is our S&P 500 ETF. So those are going to be our Y's. And then I press comma, and then I put in the known X's. And those are going to be the returns for the size and style indexes. Just like that. Then close parentheses, and then before you press enter, hold down Control Shift and then press enter. Oh, okay. Oops. I made a mistake here. I need to add two more things here. Comma, true, comma, true. Otherwise it doesn't give us what we want. Okay, there's the correct regression. So equals lineest, highlight the returns for the S&P 500, highlight the returns for all of the indexes, size and style indexes, and then type in comma true and then comma true. So the first comma is saying that there is an intercept. If you put false here, it's going to force that intercept to be 0. We don't want that. Then the second true tells the function to also produce all of the other information for this table. Otherwise, you just get the coefficients from the top line here. Down below, I had it calculate the t-statistic, which is just the coefficient divided by the standard error. And the probability value, so what we're looking for here is if it's less than 0.05, we generally refer to that as being statistically significant. And it is for that formula, and I have it up here for you, but just to explain what it is. So it's a t-distribution with two tails. That's what that means. We're taking the absolute value of our t-stat. So if we have a negative one here, if you try to put a negative number into this function, it's going to give you an error message. So we force it to be positive by using that absolute value, and then the degrees of freedom for our t-distribution are the degrees of freedom for the regression. So in this case it's 55, and where that comes from is that we have 60 observations. We have 5 parameters: small value, small growth, large value, large growth, and the intercept. So there's 5 parameters. So to get our degrees of freedom, we take the number of observations minus the number of parameters. We can see here that the S&P 500 is, not surprisingly, heavily related to large value and large growth. The coefficient for small growth is small and negative, and the coefficient for small value is small, very small and positive, but the small value is statistically insignificant. The small growth is really, there's not a whole lot there, although it is statistically significant. It is also negative. And the large growth and large value are very statistically significant. You might notice that these are in the opposite order that the returns are in, and that's just normal. This is how Excel does those things. So what I want you to do up here is to do the same thing, but instead of using the S&P 500 returns, use the returns for the student investment fund, the portfolio value here in column B. So that should give you an idea of the size and style. And one of the questions I ask you is the S&P 500 a reasonable benchmark for our portfolio? And maybe this will help you answer that question. The risk measures. So I already calculated the Sharpe ratio for the S&P 500. So the Sharpe ratio, just to do it again, you can also just make it equal to the value on the page. But the Sharpe ratio is equal to, if I go back to returns, so for the S&P 500, using a 1-year risk-free rate, so the S&P 500 with a 1-year risk-free rate is in column N. I'm going to take the annual value for the annualized market risk premium divided by the standard deviation. And then I press the comma here to format it correctly. I'm going to do the same thing for the student investment fund. Also go back to returns. Here's the 1-year annualized return, and then the standard deviation. And we get 0.94. So the way to interpret this is that the student investment fund outperformed the S&P 500, what we're using for the benchmark, because its Sharpe ratio was higher than the one for the S&P 500. And again, here I'm using the 1-year risk-free rate, 1-year Treasury as the risk-free rate. What I'm asking you to do is calculate this using the 10-year U.S. Treasury yield for the risk-free rate. So the next thing we're going to calculate is the Jensens Alpha. In order to do that, we're going to first calculate the beta for the student investment fund. And then we're going to calculate the expected return for the student investment fund, and then calculate the Jensens Alpha, which is the difference between the actual return and the expected return for our 5-year period. For these blue cells, we're using the 1-year U.S. Treasury yield as the risk-free rate. What I'm asking you to do is to repeat this analysis and this work using the yield on the 10-year U.S. Treasury as the risk-free rate. So to calculate the beta, I'm going to calculate the slope of the line for the regression between the excess returns for our student investment fund. So this is for each month. This is the return for the fund for the month minus the 1-year U.S. Treasury rate for the month. And then I'm going to use the excess return for the S&P 500 minus the risk-free rate as my x variable, and then close parentheses. So we get a beta here of 0.90, meaning that the student investment fund for that 5-year period was less sensitive to market risk than the average firm or the market itself. The 1-year U.S. Treasury, for this we're going to take the annualized value of the monthly yields on the 1-year U.S. Treasury. Again, this is going to be different in your analysis down here because you're using the 10-year U.S. Treasury. So I'm going to put in here equals 1 plus the average. So I'm going to take the average monthly return and annualize it. I'm going to go back to returns. So this is column G. So this is the monthly yield for the 1-year U.S. Treasury. I'm taking the average value there, putting in a second parentheses, raising it to the 12th power, and subtracting 1, and this is to annualize that number. So it's 1.36%, which is pretty close to what it is right now. And so the market risk premium is the average. In this case, what we're using is the average return for the S&P 500 minus the risk-free rate for our 5-year period. And so we've already calculated this. It's on the returns page. It's down here at the bottom. So it's under the column for the S&P 500 minus the 1-year U.S. Treasury. It says 7.70%. The value you're going to use using the 10-year U.S. Treasury is in this next column here that you'll calculate. Okay, so now we have everything needed to calculate our expected return. Let's go back out here to our document that shows the calculations. So our expected return is E and then RI, and that's equal to the risk-free rate plus the beta multiplied by the market risk premium. Again, the RM minus the RF is the market risk premium. or the excess return for the market. So you don't need to take the return for the market minus the risk-free rate here. We've already calculated that. And that's our market risk premium here of 7.7%. So our expected return is equal to the 1-year U.S. Treasury plus the beta multiplied by the market risk premium, or 8.292%. So the last thing we need to do to calculate Jensens Alpha is to take the actual return for the student investment fund and subtract from that the expected return. So here we're going to find the actual average annualized return for the student investment fund and subtract from that the expected return. So I'm going to go equals. I'm going to go out to returns. I'm not going to use this number because this was the excess return that 11.91% was. Instead, I'm going to take the monthly average of the portfolio here. So I'm going to put in equals, open parentheses, 1 plus, highlight the returns for the portfolio. Since these are monthly returns, I want to annualize them. Sorry. So to calculate Jensens Alpha, I'm going to take the actual returns for the portfolio, and I'm going to annualize those. So I'm going to put in equals, open parentheses, 1 plus, open parentheses, average, then highlight the returns for the portfolio, put another parentheses around that, raise it to the power of, put one more parentheses around that, and raise it to the power of 12, and then subtract 1 from the answer. And I get 13.41% for the average annual return, and from that I'm going to subtract out the expected return of 8.29% to see a quite sizable alpha of 5.12%. And so you'll need to do the same thing down here for using the 10-year rate as the risk-free rate for the portfolio. The risk-free rate to calculate our returns here. The trainer ratio is equal to the excess return. So you can see that here. So we take RI minus RF. That's going to be our excess return for each, in this case for each time period. And we're going to take the annualized average of that, divide it by the beta for the investment. For the S&P 500, this is pretty straightforward. It's just that excess return, the market risk premium of 7.70%. I'm just going to go out here to returns, go down, and highlight that 7.70. And the denominator is the beta. The beta for the market is just 1. So we could calculate that. Actually, I'll go ahead and do that. Equals slope. My known y's are the S&P 500 market risk premium, my known x's are the same values, and so we get 1. So the denominator in this case is just 1, so that doesn't change our value. In the second case, the student investment fund, we're going to take the average the annualized average excess return. Again, I'm going to go to returns here. I'm going to select this 11.91% because that's the average annualized return, excess return. I'm going to divide that by the beta, which we've already calculated over here, which was 0.90. And so my trader ratio is considerably higher for the student investment fund than it was for the S&P 500. So again, it's outperforming the benchmark. Finally, the last risk measure and risk return measure that we're going to have is the standard deviation. Pretty straightforward. Just calculate the standard deviation of the S&P 500 and the student investment fund and compare them. So we want to also annualize this. I'm going to put in equals stdev.s, and then I'm going to go back to returns. I'm going to highlight column I, and then I'm going to multiply this times the square root of 12 to get 12.73%. And so you'll do the same thing for the student investment fund and compare which one is riskier based on standard deviation. So that's what you need to do for this page here, is to calculate everything now for the yellow cells. Let me know if you have any questions about that. The last item is return measures. So this is the average annual returns, not adjusting for risk. And so we're going to take the last 1 year, the last 3 years, and the last 5 years returns. Pretty straightforward here. We're just going to annualize the monthly returns for those time periods. So for here, for the S&P 500, I'm going to put in equals 1 plus average. So I'm just annualizing the average return. Going back to returns here for the S&P 500. So I'm just going to take the last 12 returns, put in another 2 closed parentheses there, raised to the 12th power minus 1. So for the window for the last year, the previous year was 7.62%. For the last 3 years, again, I'm going to take the previous 36 and then I'm going to raise that again to the 12th power because these are all monthly returns, and then subtract 1 from that. Oops. No. Sorry, I forgot a parentheses. There we go. It's 10.9%. And then for the entire 5-year period, I'm going to do the same thing. Equals 1 plus the average. Then I'm going to highlight all of the returns because this is for 60 months. And I did the same thing this time. I need to add a parentheses right here. And I get 9.15%. So this is our, this finishes up the workbook here. Your job now is to fill in all of the yellow blanks for each of these things. So you'll be calculating what I just did for the, I apologize, there's a mistake there. That should be 38. There we go. Yeah. Okay, so you need to fill in the yellow blanks in each of the cases. Let me know if you come up with any questions or if you spot any mistakes I made that I haven't fixed in post-recording. I found several mistakes as I was recording and have gone through and done the best that I can to correct those in editing. You might notice 1 or 2 where things seem to change on the workbook and or the equations here in the video, but what you're getting is the final result. All right. Let me know if you have any questions. Again, this is due by 5 p.m. on April 1st. What we're going to do with this information and the answers that you provide for the questions is then you're going to have your first vote. We're going to figure out a way to do a virtual meeting. You're going to have your first vote on changes that need to be made to the portfolio going forward, and that's going to direct our efforts for the next 2 assignments for the class. All right.